and thank you very much. Thank you, Renee. Thanks to CIFR, thanks to Fern, thanks to KPMG. I'm very happy to be here, and this is quite a distinguished audience to be addressing, so it's really a wonderful opportunity to see how these ideas resonate or don't here. I have to say that as I was thinking about presenting this here, I thought, well, gosh, this looks provincial. The paper was written with very much a U.S. focus, and I thought, well, could I make some quick changes to make it more international? And then I realized, well, I really better talk about something I know about. So I gave up on that idea, but I think that the panel is going to try to put some of these things in an Australian context. But also I think that as I speak, I hope that you'll see where there's analogies and where there aren't, and I'll very much welcome your feedback on all of that. I know that in these kinds of dinner talks, you really should start with a joke. And I didn't know any jokes on systemic risk, so I did what everyone in the modern world does, which is I Googled jokes on systemic risk. And the only kind of thing that came up was the European bank stress tests. What a joke. So that was the best I could do. So I guess there are no true jokes on systemic risk. So I think I'll just jump into the heart of what I want to talk about. So I think I was introduced primarily as an academic, but my own view of myself is I stand squarely between academics and being a government economist. I've always been very interested in public policy, and I've gone back and forth to various jobs in Washington, D.C. So I, in particular, have had quite a long-term relationship with the Congressional Budget Office, and it's the job of the Congressional Budget Office to put a price tag on all the activities of government, so that when Congress is making a decision about how to spend money, they'll know if one thing is more expensive or less expensive and how to stay within the budget. So since I am a financial economist, what very much captured my attention the first time I got there, which was as their chief economist back in 2000, is that the government is okay at figuring out how much it's spending on tanks and welfare, but they're abysmally weak at figuring out what they're doing in terms of financial assistance, because as we all know, it's a much more complicated kind of question. So it started me off on the path that I'm going to talk about tonight. But the paper that I'm presenting now on systemic risk was really motivated by quite a simple idea, and that is, I'm sure it's the same in Australia, but in Washington, there's a lot of focus now on addressing systemic risk, and Congress passed the Dodd-Frank Act almost exactly 2 years ago from today. And the purpose was to try to set up, in a few thousand pages of legislation, some mechanisms that would better control systemic risks and prevent the kind of damages to the real economy and to taxpayers that occurred during the recent crisis and in its aftermath. So as part of that Dodd-Frank Act and to address systemic risk, it set up an organization called FSOC, which is the Financial Stability Oversight Council. And the idea of FSOC is to take the leaders of all the major financial regulators in the United States, the Treasury Secretary, the Federal Reserve, the head of the SEC and the CFTC, and so all the major regulators, and have them form a group that met periodically whose main focus was systemic risk. So to sort of break through the silos across those different government agencies to try to figure out what was systemic. And as part of that initiative, they also created something called the Office of Financial Research. That Office of Financial Research is tasked with developing metrics, creating data sets, that will help FSOC, help the government evaluate systemic risk and understand the connections between financial institutions. And so, well, just as far as the politics go, I think many academics in finance see the OFR as a wonderful institution because it's funded through the Federal Reserve, which doesn't have to go to the central government for their funding. So it's perceived anyway as a potentially deep-pocketed institution to do research on systemic risk, but it was set up that way on purpose to try to really give it power to develop metrics, to develop information that would be useful in controlling systemic risk. So I've been sort of involved in the discussions about what they would be doing, how that office would be set up, and something that struck me very much in all the conversations there was that the focus is almost entirely on private sectors. What should we do with banks? What should we do with insurance companies and so forth? And my experience of the government made me think, well, the private sector is certainly not the only source of systemic risk. There's certainly systemic risks that arises from the government, and it would make sense for an intergovernmental kind of focused institution to devote some of their research and some of their funds to looking at themselves as sources of systemic risk. So I wrote this paper with the hope that it would convince the OFR to think about thinking about the government as well as thinking about the private sector. So I have made this case to a conference. The OFR does know what I think. I want to sort of go over it with you too. So the idea is basically to make the case that the government itself is a major source of systemic risk, to discuss the reasons why, and then finally to talk about some initiatives that could help mitigate the risks that arise from the government. And I'll be very interested in your views on some of those suggestions. It's a pretty ambitious goal for a paper, and it would be only fair to mention a few caveats. The first of which, this is not an anti-government diatribe. Of course, the government can be a very important counterbalance to the systemic risks that arise in the private sector. I think that both the government and the private sector have done their share of harm, and they're responsible for fixing different things, but certainly the government is also a contributor to systemic risk, so it certainly isn't the only systemic risk. I also have to say that my analysis isn't comprehensive. The government does many, many things, and I'm only really focusing on their direct financial activities. For instance, I'm not talking about the systemic risk that arises from large fiscal imbalances, certainly important. And I don't rank these risks by their order of importance. It's more of an anecdotal discussion. And I'm not going to compare the magnitude with what happens in the private sector. In any case, the first thing that I want to convince you all of is that the government in itself should be thought of as probably the largest financial institution in the world. I think this is true of the US government all by itself, and it's also true of other governments. So I just want to show you a few statistics to support this idea that the government itself is as large a financial institution as other financial institutions. So I just have just a few slides to sort of make this point, and this is in the context of the US government. Now, when I talk about the government as a financial institution, a sort of narrow interpretation would be the government acting as a bank, even in normal times. So at least in the US, on an ongoing basis, the government plays a very large role in certain credit markets, both through direct lending and through making loan guarantees. What I have in this picture is the volume of credit that's government supported through the decade that ends in about 2010. I realize it's going to be hard for you to see this, but the largest bars, which are the light blue at the bottom each year, represent federal government guarantees of housing, basically mortgage guarantees, and that's their ongoing programs that assist low-income families to get housing, assist veterans, some of that is for rural housing, so those are the sort of the big ongoing government mortgage guarantee programs. The next largest credit programs that are supported by the US government have to do with student loans. So the yellow there are student loans, the volume of government-supported student loans. That number has now gone up to close to $1 trillion of government-backed student loans in the United States. And that was the one sector of the US credit market that grew very rapidly during the financial crisis. Other support to small businesses, to trade credit and so forth are a smaller fraction. But if you add all that together, just those traditional loan activities of the US government, these are not special crisis programs, just the normal stuff, about $2.3 trillion of credit outstanding. Now, of course, the financial crisis pointed out that the biggest federal financial institution that's part of the US government is Fannie Mae and Freddie Mac, who insure a large fraction of mortgages made in the United States. The graph I have there looks at the same period of time, and I've superimposed Fannie and Freddie on top of those other government programs that I just showed you. When you include Fannie and Freddie, you get to a total of government-backed credit of about $8 trillion. As I've drawn those bars, the first set of them are ghosts. Those ghosts date back from the time when the government guarantees on those institutions were implicit guarantees, not explicit. When the financial crisis caused the companies to go into financial distress and caused the US government to take them over, they became explicit obligations. And so anyway, now the total goes up to about $8 trillion. Now at the bottom of this slide, I'm just noting that that's the very literal kinds of credit guarantees. On top of that, the government provides various kinds of insurance. This is sort of alphabet soup. But if you add up all that coverage, you find that the U.S. government is approximately a $20 trillion financial institution. So how does that compare with the private sector? They're as big as any of them. So this is just if you, it's not a perfect comparison, but just if you compare the largest financial institutions, they're certainly smaller than the size of the intervention of the U.S. government. Or even if you look at specific sectors of the economy in the U.S., non-mortgage consumer credit is only $2.4 trillion, much smaller than the total size of the government's intervention. So the government is an important financial institution. And I'm sorry, and I'm going to blank this out now and go back to just talking, sorry. I would argue that the attributes that give rise to systemic risk in general, systemic risk in the private sector, for the most part, also apply to the government.